I had a question in regards to my 401k. It's doing really well this year, and that is due to the current stock market trend. However, there's been some guesses that the stock market might take a downturn in the future, possibly a few weeks, months, or maybe even a year or two from now. Would you recommend doing something like switching from 100% stocks, which is currently what I have in my 401k, to 100% bonds or a higher percentage of bonds? I am still about 20 years away from the traditional retirement. My plan would be to switch over to 100% bonds in order to ensure safety and ride out market downturn, and then switch back to stocks once the market starts trending upward again. What do you think about that plan? Thanks so much.
Okay, so Pam, like a lot of investors, is worried about the stock market. Worried about it going down and asking, should I switch from 100% stocks to 100% bonds, or at least a higher percentage of bonds, and then switch back to bonds or switch back to stocks when the market's going to go back up? This is basically asking, should I time the market? And the reason you should not time the market is that it is incredibly difficult to do well over the long term. Plus, it introduces significant transaction and, in a taxable account, tax costs to the equation. So not only do you have to be able to time the market well enough to beat the market, but you also have to do it well enough to overcome the costs of doing so. And in the long run, it turns out that's very, very difficult to do. And so I would not advise trying it. What's interesting, though, is I've noticed a trend. The beginning investors, they have trouble staying the course in market downturns, meaning the market tanks. The stock market falls 20, 30, 40%, and they bail out at the bottom and end up buying high and selling low. But I've noticed a similar problem among what I call intermediate investors, people who have learned a thing or two about investing. And instead of becoming fearful at market bottoms, they now become fearful at market tops. And so they want to sell when the market is at, new highs. What they don't realize is that the market is usually at new highs because it is usually going up. And so any concerns you have now about the market being at a high, I assure you that people have had for pretty much the last 10 years. And yet going to bonds at any point in that time period would have been the wrong move. Now, one of these days, it will have been the right move just before a big bear market happens again. But the truth is that's so difficult to tell in advance that it's really not worth trying. You are much better off setting a static asset allocation of a reasonable mix of stocks, bonds, and or real estate, and rebalancing back to it each year. That way you hold your risk constant, and when the inevitable downturn comes, because it's going to come, you can simply rebalance back to your percentages. And what that does is it forces you to sell high and buy low, because you're selling what did well in the recent past and buying what did poorly in the recent past to get back to your planned percentages, your planned asset allocation. And that is the recommendation I have for you, Pam, with regards to this question of whether you should try to time the market. Don't do it. Just get a good long-term plan in place. Because here's the way to think about it, right? If you look back at market history, you will see that on average, we see a market correction, a drop of 10% or more in the stock market, about once a year on average. So if your investing career is 60 years, 30 years while you're working, 30 years in retirement, you're going to see about 10% drops in the market. So this is not something that's unusual or something that's rare. This is something you should be planning for. This just happens. This is what stocks do. And you should bake that into your plan, that you're not going to sell when they go down. If anything, you're going to buy more. Likewise with a bear market. A bear market is often defined as a 20% plus drop in stocks. And how often does that happen? Well, on average, it happens about every 3 years. And so how many of those are you going to go through in a 60-year investing career? You're going to go through about 20 of them. It should not be unusual. You should not feel like something weird is going on when the stock market drops. It just does this from time to time. It did this in 2000. It did this in 2008. It did this in 2011. It even did this in December of 2018. You might not have remembered it because it only lasted a couple of weeks. But these stock market drops do happen from time to time. They're not a reason to panic. And they're not really a great opportunity to try to time the market because they are so hard to forecast when they're going to happen, how severe they're going to be, or how long they're going to last. You're far better off just having a know-nothing, static portfolio that you rebalance periodically and take advantage of every asset class having its day in the sun. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.